Okay, hello everyone. Welcome to this week's Minervini on the Market Weekend Weekly Report, August 4, 2024. We had an interesting week last week. Market indexes came under heavy selling. Key components, of course, were affected. Major indexes negative now. Up down volume also turned negative. New highs, new lows, neutral, but close to turning negative also. And individual stock participation has been negative, and that is certainly evident in our STEM model, which turned red, our most cautious hard penny environment reading on July 17th. And that's also been very evident in our own trading. When we take a look at the Minervini Select Trade portfolio, we've made some very, very specific low risk buys coming out of well-formed bases and had no traction whatsoever. And that was the canary in the coal mine, as far as I'm concerned. And certainly that has led to we've seen a pretty difficult environment here. Now, of course, market has been under pressure, and I've been talking about caution and high levels of cash for a little while now. But the SPY advisor models are remaining on their buy signals. And you might ask, why not, sell our SPY position? Well, the SPY models are very mechanical, specific, long-term trading model or trading strategy. And if you start circumventing that, well, then you don't really have a strategy. So you have to realize that with the longer term models, you're going to come off the highs sometimes by quite a bit before you get a sell signal. And sometimes the sell signal is right when you make a bottom, and then you have to come back in on the uptrend, and you're not going to get the low either, because it's a longer term trend model that you have to have the trend in place on the buy side before you get a buy signal. And on a sell signal, you have to roll over and show that the market has indeed shown some topping action. And the trade-off for that is that you get the longer term nature where it'll keep you in for a long period of time. So during bull markets, we go back and we take a look at the 33 model here. 25 was the same. You go back to the 1990 buy signal right here. That stayed on a buy signal for 10 years. Right. So in order to get that, you've got to go through a bunch of pullbacks. And this actually went through the 1998 bear market, which was quick, but it was pretty severe. So there's been times where the model has stayed bullish and you've had to go through some decent pullbacks. And again, this is where you see right now we're going through a pullback, but we haven't gotten any sell signal or any laddering yet. Now, sometimes you'll get where you go into a pullback and you don't get an outright sell signal where it goes to 100% cash, but it ladders out and you get into some cash. That happened before the 87 crash, where prior to the crash, when you went into the crash, you weren't completely in cash. It didn't time us out, but it did raise cash. It raised, I believe it raised 66% cash, or only 33% going into the crash. So pretty protected. And that's the benefit of laddering versus using a switch. If you just wait for the switch signal to go to cash, well, then you're not bending with the market as much. So they both get you about the same return, but the signals, the direct switch signals, could create some more volatility. So I like the laddering myself. And right now we haven't laddered, but I expect if the market corrects much more from here, you'll certainly see you'll see some cash being raised. Now, one of the reasons also that why you're not raising much cash in the SPY model is because it didn't really come in very much. It's not down that much, down about 6% right now. Some of the other indexes and individual stocks are down a lot more. So this is responsive to just that index. It doesn't take into account other indexes. And speaking of other indexes, the NASDAQ is one to look at here, because we came under distribution off the highs there. And that first distribution day certainly was a shot across the bow. With that second distribution day after that dead cat bounce, you had a couple days, and then a few days later, came off pretty hard on an increase in volume. That was pretty much, where we started to see it was getting pretty obvious that this market was, going to correct. Since then, had another big distribution day here after, once again, just a few days of a dead cat bounce. But then we got a bounce on Wednesday, and it was pretty convincing. It was so convincing that people were heckling me on Twitter, telling me that the bottom was in when I was making cautious comments. I like to wait. When I get a follow-through day or an accumulation day off the lows, I like to wait to see if there's any immediate distribution, certainly in the first few days to as much as a week or two before I start getting aggressive. And you could see the very next day, and the general rule of thumb is the sooner the distribution comes in after the follow through day or the accumulation day, the more ominous it is. And this came the very next day on a big outside day. It was with that kind of action, it was almost certain that we were going to get some follow through to the downside. Friday, we did follow through to the downside. Volume did not pick up on the Nasdaq, but when you take a look at the New York Stock Exchange, the NYSE, it did, and we had a pretty big down day back to back there on Thursday and Friday, with volume increasing on both days. So clearly, we're under distribution, and more importantly, volatility has picked up. And when volatility starts picking up to these types of levels, we saw the VIX now double off the lows. This is something, of course, that we were expecting for quite some time. We went a long period of time without a tripling off the lows or a doubling off the lows. So talking about this for weeks and weeks on end now, and finally, we're seeing that volatility that we were expecting. So when you get volatile like this, we don't want to start jumping in there and start trying to pick bottoms, because the backing and filling, the whipsawing can really cause you a lot of havoc in your portfolio, especially on those individual breakouts. As they break out, they squat, they fail. Just something that you want to avoid and wait for just clearer skies here. Another thing that's interesting here, and I think things have shifted now. There's been a shift from um, bad news is good to bad news might be bad now. And that's where you see the yield, the 1 year yield. And this is one of my canaries in the coal mine. And I look at it, it means different things at different times. At one time, when we go back, we had rallies where declining interest rates went inverse with the market rallying. You peaked here, where you bottomed, and then you rallied as the rates came off. Now, more recently, we were rallying around the time we were rallying in the rates, and then the rates went sideways. And now, as we're rolling over, we're actually rolling over with the rates. What that means is that we've shifted from inflation worries to recession worries. And now we're pricing in the potential that the Fed is behind the curve, and they haven't eased fast enough. Sorry about that. Sorry about that. My phone was in my pocket and it started ringing. And so now, bad news is not good news anymore. Bad news is now being looked at as bad news. So now those economic reports that come in soft, if the Fed doesn't start easing, like I said, we'll go very quickly from inflation worries to recession worries. But all this comes back to a chart that I've shared with you many times, and certainly recently, talking about the Goldilocks scenario and how these sustainable markets happen during periods of moderate to stable economic growth. You can see that we have these very long sustainable bull markets. They all happen when you have that nice moderate growth. It doesn't really, that range doesn't get disturbed for an extended period of time. And we have been in that, not for a long time, but we've been in that Goldilocks scenario. If you go back prior to the 1980s, or prior to 1985, we had big wide swings in it was like a lot of volatility in the real GDP and the economic data. And that was a period where we had a long period of time where the Dow and the S&P, the general market, couldn't make any progress. But then finally, when we got that under control, that's when we had those nice bull markets. And that's basically been what we've seen for a long period of time. There's been no real inflation, and recessions have been met with QE, quantitative easing. And the only time we had that spike in inflation is recently. And yeah, it was told that we were told that it was transitory. And looking back over long term, it is somewhat transitory compared to maybe going back to the 1970s inflation. But that's been the worry for quite some time now. I think that's starting to shift now, and we're starting to see now the softening of the economy is going to be what the focus is going to be. Now, this could lead to some type of correction that is in line with the seasonality. If you look at the S&P 500, seasonally speaking, this next period of X amount of days in this part of the year is looking like it can consolidate or correct a bit. And that leads right into that strong period of the second half of this year and the first half of next year. Whether you look at the 4-year presidential cycle or you look at the seasonality work, we do have a tendency to be strong going into the second half of the year. So I'm looking for this correction to set us up in a manner where we get a good buying opportunity coming up. Now, as I pointed out with the longer term SPY model, the S&P 500 is only down about 6.3%. So this is a completely normal pullback. It's actually fairly shallow. You'll get 5, 6, 7%, maybe even 8% pullbacks in the S&P, usually early on in a bull market, and then they might move up to 10 or 12 until later after you get a good move in a bull market that's been aging. You'll see 15, 20%, and then the semantics will change to a bear market. We take a look at the Nasdaq. We're down about 11% off the highs. Again, that's about in line, even if we came off a little bit more, 12, 13, 15%. I think that would be a normal pullback here, maybe get below the 200-day. And then when we take a look at something like the IBD 50, this is where we're getting into more specifically the type of names that maybe we would be trading. That's down about 17%. And the general rule of thumb is, depending on what index you use, the general rule of thumb is that individual stocks will correct during corrections in bear markets anywhere between 1.5 and 3.5 times the general market. So you take a look at something like Micron. Here's a perfect example. This stock's off almost 42% off the highs. Remember, we were buying this back off the 50-day here, the pullback, adding to it, sold it into the strength. Looked like it might have been a normal pullback here, but then we rolled over, the violations started piling up. Now we're below the 200-day, and the stock's off just like that, 42%. If you held through this and you didn't take those profits, you now, just to get back to where you were, you have to go 72%. Now, let's just say this stock comes off just a little bit more, another 5, 6%. You're down 50% off the highs. The stock has to double now, has to go up 100% just to get to where you already were and get back to break even. And this is why you need to sell into strength, protect yourself, and certainly on your profits, when you get at a decent profit, draw a line in the sand at that break even. If you haven't financed your risk and covered it by taking a partial off, then definitely protect that break even. And again, we've added that nice finance risk calculator, which some of you may not know what I'm talking about, but if you go in analytics and you look at the calculators, there's a risk finance calculator, great tool for deciding how many shares you have to sell to finance your risk. And so if your stock's up 30%, you have to sell X amount of shares. You own 1,200 shares. It'll tell you exactly the number of shares to finance different levels of risk. So you should take a look at that and use that tool when you're financing your risk. Let's see, what else? Summary distribution in the market here. We're under pretty heavy distribution on the indexes. We're seeing pivot failures and few setups. If I had no other information whatsoever, that would get me pretty much into cash, or certainly mostly cash, and very, very cautious. Add to the picture here, we've got volatility that's very elevated now. Sentiment has not come down to levels where we would call it pessimistic, consistent with bottoms. So still complacent at best on the sentiment. So we want to see sentiment improve, which I'm sure last week's action will improve the sentiment, but I don't think to levels that we could say are bullish from a contrarian standpoint. STEM is red, okay? And with taking all that in consideration, there's only one conclusion, and that is, cash is king right now. And it's been that way. We've been talking cautious for a number of weeks now, and certainly the traction that we've seen has warranted that caution. So we're going to remain cautious here. We'll let a few days go by here and see how things transpire this week. I don't think, I think we might be able to see a snapback in the market. We're short-term oversold. But I wouldn't rule out maybe some kind of mini meltdown here if things really, start to get out of hand here. If we see economic data, come in weak, you may get more slide here and have to get more oversold, more volatility. So just be careful right now. The volatility is something that you don't want to play with as a low risk stock trader. Tomorrow, of course, Monday Q&A, myself, Mark Ritchie, at 11:30 a.m. Eastern time. We'll answer your questions and have more discussion. Tutorials this week, I'm going to try to get in some type of discussion or tutorial or Q&A. We've just recently put a few more enhancements, a few more changes to the platform. Pretty much every week we're adding things or changing things, improving things. So we'll probably have something, some discussion about that. I'm waiting for them to do the new push. Thursday, of course, Q&A with Mark Ritchie and Brandon. And let's see what this week brings us. And we'll see you. We'll see you tomorrow. All right. Have a good rest of the day, and talk to you tomorrow. Bye bye.